What if I told you the stock price you're watching isn't moving naturally? What if big investors already know where it's going, and they're using your emotions to get there? Stick around, because after this, you'll never trade the same way again. The stock market isn't a level playing field. It's dominated by players with billions, and they don't play by your rules. These big investors don't just react to the market, they move it. Their size lets them push prices in ways that benefit them, often at your expense. In this video, I'll reveal the tactics big investors use to manipulate prices, from stop-loss hunting to fake breakouts and news manipulation. By the end, you'll see the game in a whole new light. So, who are these big investors? Not your neighbor or a YouTuber with a big portfolio. We're talking about hedge funds, pension funds, mutual funds, and investment banks, institutions that move billions with a single trade. Their trades are so massive, they can't just buy or sell like you do. If they did, they'd move the price against themselves. They need liquidity, pools of buyers or sellers, to execute their trades without causing huge price swings. And where's the most predictable liquidity? Right, where retail traders put their stop losses. Your safety net is their entry point. If everyone sets stops at $95, that's a goldmine for institutions wanting to buy cheap. They push the price down, trigger your stops, and scoop up shares at a discount. Their strategy is built on exploiting predictable retail behavior. Big investors aren't looking for bargains, they're looking for where you're vulnerable. This is the foundation of their game. Let's break down the stop-loss hunt, a daily tactic in the market. Stocks trade calmly, then suddenly drop below a key support, triggering a wave of stop-losses, only to bounce right back up. This isn't bad luck, it's engineered. Institutions use algorithms to find where most stops are clustered, below recent lows or round numbers. They sell aggressively to push the price down, triggering your stops and creating a cascade of selling. While you're panicking, they're buying everything you're forced to sell, at a discount they created. Once their orders are filled, the price snaps back up, leaving retail traders with losses and confusion. The stop-loss hunt is how institutions manufacture the liquidity they need. They don't find liquidity, they create it. On the flip side, big investors use fake breakouts, bull traps, to lure in momentum chasers. A stock breaks resistance on high volume, triggering FOMO. Retail traders pile in, thinking it's going to the moon, but the smart money already bought lower. They push the breakout, then sell into the buying frenzy. As retail traders buy at the top, institutions unload their shares. Once they're done selling, the price collapses below resistance, trapping late buyers in losing positions. The breakout fails, and retail is left holding the bag. Institutions create these exit liquidity events. They don't chase breakouts, they engineer them. When the dust settles, the price drops, and the cycle repeats. The lesson? Don't be the last one in at the top. Recognize the trap before you step into it. Now, let's talk about the psychological game, how big investors use news and emotion. They know fear and greed drive retail decisions, so they use news as a trigger. Before good news, they accumulate shares quietly. When the news hits and retail buys, they sell into the strength. The stock pops, then drops. Classic, sell the news. With bad news, panic selling creates a buying opportunity for institutions. They buy when you're scared, using your fear as their entry. By the time news is public, smart money has already positioned. They use headlines to trigger predictable retail reactions. Whether it's greed or fear, their goal is to exploit your emotions. Your reactions are their opportunity. So, how do you protect yourself? Don't try to outmuscle institutions, think like them. When you look at a chart, ask, where are the obvious stops? Where would retail get trapped? Avoid placing stops at obvious levels. They're targets, not safety nets. Consider wider stops or manage risk with position sizing instead of hard stops. Wait for the stop-loss hunt, then enter after the price reclaims key levels. Don't chase breakouts. Wait for confirmation or a retest. Be patient. Don't let FOMO make you the exit liquidity. Control your emotions. When news hits, pause and ask, is this real or just noise? Buy when others are fearful, sell when others are greedy. Awareness and patience are your best defenses. Don't trade obvious patterns in obvious ways. Start thinking strategically, anticipate the big players, and pick your spots. Now you know how the big players operate. It's a game of liquidity, psychology, and manipulation. But with this knowledge, you can spot the traps and avoid being the exit liquidity. Be patient, control your emotions, and use their tactics to your advantage. If this changed how you see the market, hit like, subscribe, and comment "smart money" below. You're no longer a pawn, you're a player. Thanks for watching. See you in the next video.